Welcome to Opalesque TV. I'm in Pfaeffikon in Switzerland together with Claude Porret. Claude is the founder and CEO of 47 North. 47 North is an asset manager specialized in emerging managers and innovative strategies. Claude, I know you for many years and you have quite a career in asset management and finance. Tell us a bit about your background and how you set up 47 North.
I have an engineering background and always liked to deal with numbers, was not very good at building machine. So decided to move on and did an MBA. From there on, I was hired by Salomon Brothers, which was at the time the king of Wall Street. And that's really where I discovered my love for finance and everything which has to do with finance. Through Salomon, also went one stage further into the discovery of finance, was more everything which had to do with derivative. Was in the late 80s, was the beginning of derivative option, swaps trading, and other instrument call and put. And then I moved into this direction, but always on the selling side, went abroad, see many countries like Japan. I lived there for Salomon. Then I went to London, to New York, they finally sent me back to Switzerland. And from there on, I moved into being a trader myself, and we were managing the exposure of the company, and with the profit we made, we were investing it into hedge fund. That was back in the beginning of the 90s, and that's really where I saw where the future of the financial market were going, toward people having an entrepreneurship mind, no political involvement in any type of management, being creative with financial product. And I moved on to RMF, where I was hired to manage the seeding effort, early stage manager seeding. We had gotten a big mandate from a Swiss insurance, which was interested also in getting quality capacity. At the time, capacity was a big constraint. And the idea was that if you see the manager, you can reserve capacity and then use it for your own investment. It was back in 2001. We did there 19 deals. The industry evolved. Quality capacity was abundant. We also got acquired by Man. RMF was bought by Man. We had a different view of conflict of interest, i.e. we seeding manager, and then Man RMF invested in the manager which were seeded. Is it a conflict of interest or not? It became a little bit messy, and so we decided with the team there was time for us to move on, which we did. In 2006, we started 47N with the idea of doing exactly what we had done before, because we still thought was where the industry was going, toward more specialized product. And also we always felt that early stage manager were, to the contrary of the perception, were less risky as far as the downside was concerned than the established manager or legend.
Claude, I also know that you at 47 North, you manage part of the emerging manager program of CalPERS, the large California-based public pension plan. As you have explained, you have invested in emerging managers for a long time. And obviously, with your program, you also went through the financial crisis of 2008. As an investor in emerging manager, what was your experience? Was it any difference, any better or any worse than being invested in the big, large, well-known hedge funds?
The experience with early stage, so as you mentioned, we got the money from CalPERS to invest into early stage managers. And that's the sole purpose of our mandate. We don't do established manager for them. We came into 2008 being actually rather aggressively positioned with the portfolio. We had target return, which were very aggressive at the mandate basis. And what transpired was that we always believed in actively managing assets And we started very early on to redeem. We actually started to redeem some of the manager back in 2007. Our experience has been extremely positive in the sense that most of the manager we were invested with did not have any gating, did not have to create any side pockets, were able to pay whatever redemption we put in on time. We were even contacted by some of these managers asking us if we had any problem, if they were going to pay some very distressed fund of fund who needed the money ahead of us. So the communication was extremely good with early stage manager. And we later on were approached by fund of fund who wanted to close down but still had to manage this orphan portfolio, i.e. fund which were gated. So we had a bit of a glimpse into what happened with the established or with the legend. And we were horrified to see how these guys have actually treated their investors. That's a large fund of fund, large investment bank having hedge fund had gated in strategy, which absolutely did not justify being gated. I'm speaking about long short equity, I'm speaking about CTAs, I'm speaking about startup. So really, again, to the contrary of the perception, early stage manager, if you do your homework, are less risky than established with the transparency you get from the manager. I'm not speaking about single position transparency. I'm speaking about knowing how they manage their business, knowing if they have liquidity problem, about on the risk side to have the transparency, what is the liquidity of underlying portfolio. If they have themselves liquidity mismatch, you get all this information with the established and legend. Most of the guys don't pick up the phone if you try to get information, unless maybe you have $200, $300, $400 million in their fund and you are an important investor.
So at 47 North, you focus on early stage managers, but also what you call innovative strategies. In your understanding or according to your definitions, what are innovative strategies?
So innovative definition is actually our own, and maybe some people will completely disagree with it, but we try to keep it simple. And we have defined it on two axes. One axis would be the axis of geographical innovation, meaning long-short equity MENA for us is still innovative. But long-short equity in the US is not innovative. Then you have the other axis, which is more the strategy and the evolution of strategy. For example, you would have volatility. Volatility, we all have been using it, but mainly directionally all the way back in the 80s and maybe even earlier than that. Now what you start seeing is some volatility fund, and they are using strategies within the volatility universe. You speak about correlation, you speak about dispersion, you speak about relative value, you can speak about directional. And this for us is a strategy which has evolved into being innovative. Also, what we are doing into innovation is we are also looking at the long-only universe. To give you an example, we have now researched the universe for litigation funding. The laws have changed in the UK, which allow the litigation funding. And I think there are about between 5 and 10, at least, that we know of, funds which have started where one can participate in as an institutional or retail investor and profit from the return you would get into litigation funding. This is definitely a long-only strategy. You could not really hedge the leg of giving money out to fund a lawsuit. We are following it. We also have invested in it, but we know that it's a long-only. That's why we like to call innovation more alternative, as you call it yourself, alternative versus a hedge fund. Because for us, hedge fund has the long and short component. When you do seeding or when you invest with an early stage manager, very often you tend to see the new thing. They are maybe trader coming out of a big house who have had an idea and did not get the funding for it. Even somebody working on his own and discovering something where he would have had no success in a larger investment bank, came to us, showed us the idea. At the time when we were doing seeding, there was no question about to take the risk. We did it through seeding. So if it was successful, like we did seed early on CO2 manager, which really developed into to being one of the largest manager involved in CO2, you want to have maybe a higher return, i.e. if you do seeding, you get the equity stakes, i.e. the money you have invested into the management company, you get the revenue sharing agreement, and then you get the return on the fund. So seeding is the ideal vehicle for the innovative strategy. Now we do early stage, so we are not paid to take risk. So we always wait for about 6 to 12 months track record, but we still get these guys through the early stage screening, and then they almost automatically move into the innovation bucket because we see that it's not a strategy which people would consider as being just a mainstream long-short equity, relative value, event-driven or global macro. So we attain quite good economy of scale by screening the universe for early stage. Automatically we get the innovative strategies.
Now, Claude, what is your investment approach? What are the steps that you take when you select the eligible universe of managers, and what are some of the benefits that these managers can offer to a larger institutional investor?
We have an opportunistic approach. Dealing with early stage manager, you cannot really decide from a top-down approach that you want to increase your allocation to global macro and then you go out, look for early stage global macro manager. We tend more to be opportunist and to screen the manager no matter what kind of strategy they follow. So we have really a bottom-up approach, and having done it since such a long time, i.e. 2001, we can still now create the bucket where we have early stage manager in the global macro side, or having early stage manager. I was going to say CTA, but actually this is not the case. It's very difficult to get early stage manager, CTAs. CTA tend to require a huge intellectual pool of people. And so you see the largest one, whether you speak about Blue Trend, whether you speak about AHL, Winton, Aspect, and so on and so on. They tend to have a very large development department. Many PhDs are working for them, so it's capital intensive. Early stage means normally the manager does not have a lot of assets, so cannot afford a large pool of PhDs unless they are all partners, but still you would not want to see an early stage manager having 70, 75 partners in it. It would be a bit messy. So maybe CTA would be the exception in the early stage universe. Otherwise, basically all strategies covered by the early stage manager. What one has also to realize is that the quantitative approach is very difficult with early stage because you get only a few points, and to do regression on 6 to 18 points does not tell you very much. So the way we do also our manager selection is more on a peer basis. We try to create our own peers where we take the best of breed in the similar strategy, and then we compare the manager to how the peer are developing. And if we see they are outlier, then we try to explain it. And then if we can explain it, then it's all fine. If we cannot, we very often just don't follow up doing the due diligence on the manager. That means there is something he's either not telling us or we are completely missing, in which case we should not invest if we don't understand where the return or even the negative return are coming from. Also, when we construct the portfolio, we always do a quantitative analysis, but it's more sanity check versus really telling us, what is the efficient frontier and how much tenth of percentage we should invest into this manager. We use a lot of qualitative and common sense approach, which if you are in the legend or in the established manager universe, you can really more use quantitative approach. Still, we are using top-down approach because no matter what we have realized, everybody speaks about alpha and beta, but in the end we have to create return no matter where they are coming from, as long as we can protect the downside as much as we can. We are still using macro approach to see if we should overweight one sector or another, or if we think that for the next 3 weeks the equity market are going to take off. So for that we have screened also the UCITS universe. So we create hybrid product where if we have a view on the markets, we need to have the right instrument to express it. And UCITS is an extremely good instrument to express a long view on the equity market. You have liquidity mismatch, the way the risk is apparently implemented does not protect very much when I speak about downside risk, i.e. performance risk. On the positive side, the investor would not be normally subject to a Lehman type of situation. So you have some positive aspect and negative aspect on the maybe more on the administration side. Then if we look just at the strategy itself, there are definitely strategies which are completely appropriate for UCITS. Equity, long, short, large caps. We never understood why a manager would dare to come out with a quarterly liquidity, 60 days redemption. We found it completely outrageous and try to stay out of this type of managers. But on the other side, you see in UCITS manager giving you weekly liquidity for almost private equity type of investment. And this is also the type of manager we would never touch. So we don't like the liquidity mismatch on both sides, whether we are the investor or whether the manager is investing in the underlying investment. And this is not really subject to regulation. It seems that this step has not been taken into consideration by the regulator. So for us is a positive development in the sense that we can sell ourselves as helping again the end investor to avoid this pitfall. Then maybe looking at the performance of the UCITS universe. What we saw was that most of the equity long short manager, like also in the offshore, tend to be net long. You don't see very many managers who can go very quickly from being net long to being net short. People can go very easily from being net long to being flat, but the short side is always still a problem. I think we are, as human beings, too positive to really be good shorter. So that's why I was speaking about before, whether it's alpha or beta. If you have the view that the equity market are going up, long, short equity UCITS fund is really something you can use because you have daily liquidity. So if you have a 3 weeks view, you subscribe, and then within maybe 17 days or whatever, you redeem, and you have been with the manager 15 days in. Sometimes you see this huge rally. Okay, then you have to be a good timer, obviously, but that's something we could never do in the offshore world. We have maybe we missed them, but we did not see many equity managers where we would have this type of liquidity. So it's always the offshore world is you have to go for the long trend. The UCITS, you can try to do a little bit of asset allocation for the short term. And we think that the combination of both is a great opportunity for fund of fund. But as a whole, UCITS, we have been disappointed. You mentioned, how many managers we did screen. I'm sure we missed a few of them, but we went through 750 of them. We have screened seriously 40 of them, i.e. all the other we eliminated because we did not get, it could be the transparency, i.e. a lot of UCITS funds are coming from the large houses where you have absolutely no access to the managers like we used to have on the offshore side. And you basically invest blind. And so out of the 40 we really spent time on, we found a handful of manager bringing us what an offshore hedge fund would bring us. They are good beta managers. And the whole, I must say, in the 2008 period, these UCITS hedge fund manager who were already up and running did protect their downside extremely well. But never really made it on the upside. So they turned very defensive, but did not turn on the burner when the market turned. So I really think the future is to have a mixture between offshore and UCITS. This is the ideal product.
So at 47 North, Claude, you do bespoke mandates and you also offer a couple of fund of funds and one UCITS fund of fund. Tell me more about your products.
For example, for CalPERS, we have a managed account. And that's a solution we want to offer, especially also going forward. We are being very often now contacted by family office, high net worth individual who would like to have more a mandate type of approach where they come with the idea and ask us which type of manager we would like to, we would recommend. And so we would go also into this type, what we call advisory mandate. But also for the people who, especially on the innovation side, where we are selling the product as a diversified approach to what is new. We have seen, especially lately in the litigation funding, a lot of people were interested in it, but were worried about how it was going to evolve. And so we put small size into innovation, which means investor can, through participation in innovation, learn how litigation funding is going to evolve. So innovation is the right product for people who want to go into something new, but on a diversified basis. I mean, people spoke a lot about what happened to Madoff and criticized the fund of fund industry. Easy to say for me now, dealing with early stage manager, okay, we don't deal with the Madoff of the world. But if we had, as a fund of fund, nobody lost all its money. I know that some of our colleagues across the street had a position in it, but their investor lost a few %. They did not lose everything. So still a lot of people understand the concept of being diversified when you invest into something you don't understand 100%. And innovation is the perfect vehicle for that. So you can invest in volatility and through our vehicle and learn with us. We do a lot of hand-holding, we write paper for people who wants to learn more. So we, having dealt or dealing with early stage manager, we are used to work very closely with people. So new generation, it's the commingle vehicle, which is replicating what we do for CalPERS. A lot of people wanted to invest like CalPERS, but as it is a managed account, we could not let them invest into the managed account. So we created a fund of fund structure. So it's a replication of early stage. Has no other constraint than being an early stage fund of fund. And maybe something which a lot of people discuss about, when an early stage graduates, i.e. becomes into the hedge fund life cycle, turn early stage, you have rising star, then you have established, and then you become a legend. What do we do with this manager as they move up the curve? And what we have decided is that in the end, our investor want to have, if possible, uncorrelated return, but good return. And why would you want to take a manager who has turned into being a legend out of the portfolio, unless this investor has another vehicle where we could pass on the investment he has made? So we are working more like with a private equity approach, where we do vintage. So if there is not any more capacity into the fund of fund, then we don't dilute that fund of fund. We start a new one with new managers. This way, the early investor don't get diluted by having a fund of fund with 50, 60 managers. Our fund of fund are very concentrated. We believe that between 15 and 20 managers is enough to create the necessary dispersion of risk.